People who've been prudent, people who have saved are being punished. Retirees are being punished. Pension funds are being punished. Interest rates aren't naturally at zero. Interest rates were forced to zero. And if I force you to live in an environment where you get 1/10 of the air you currently get, you're not going to be a healthy Dunnigan very long. You're going to get very sick very quick. Well, what's happening to the retirement population? They're getting very sick very quick because that's the way it works. Because they're all yield starved. And you know what that forces those people to do? Because they can no longer get yield from their fixed income quotient in their investment portfolio, it forces them down the risk curve. And they end up taking bigger and bigger and bigger risk elsewhere to try and make up for the lack of return in fixed income. So we basically have turned everyone into, everyone has a seat at the casino table now. And everyone's gambling. Because if you don't gamble, you don't earn anything. And if you don't earn anything, you're finished. I've completely divorced myself from anything that I would consider mainstream. I don't believe it. I think everybody needs to own some physical metal, because I think the day this does stop working for the powers that be, you will not be able to buy physical metal. And at that point in time, I do believe that metals prices will reflect the true scarcity of physical.
This is Dunnigan Kaiser, founder of Liberty in Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty in Finance and Reluctant Preppers. We have a returning guest who is wildly popular with our viewers. This is Rob Kirby. He's a proprietary analyst and founder of KirbyAnalytics.com, and he joins us this Friday, April 9, 2021. Rob, thanks for coming back on.
Wonderful to be with you again, Dunnigan.
We always enjoy your visits here. Our viewers, when they tune in for our premieres, when we post you at 9 p.m. Eastern, and then we put a live chat available, they're always saying, "Ooh, I got to get me some Rob Kirby." Whenever I see Rob Kirby, I show up. So you have very avid and enthusiastic fans out there. We wanted to get you back on today because an article came out that I knew was right in your area of expertise professionally. You have a history of, you'll explain more about it to us, but it's in this area of the article that came out from King World News. This is the ticking time bomb that will unleash global financial chaos, written by Matthew Papenberg from Matterhorn Asset Management in Switzerland. And they're talking about the derivative complex that dwarfs the size of national debt, etc. And you've been talking with me just before we got started here about how most people don't understand the true magnitude of this and how it's related to activities relating to the bond market, the bond yield, how that impacts the dollar, how that impacts the equities market, and maybe some more insight into international trade being settled in dollar alternatives. So, on opening that whole can of worms, we asked you on to help us make some sense out of this for those of us who really don't understand all that, but hope that you can walk us through that. So would you please start with that premise about, is in fact the interest rate derivatives really a ticking time bomb that will unleash global financial chaos, or how do you look at it and help us understand it?
Well, in my view, Dunnigan, the interest rate derivatives topic is a mighty big can of worms, and once you open it, it's very difficult to get it back into the same can, because the numbers involved are measured in hundreds of trillions. So, and most people don't really understand the true nature of how these things are used by officialdom to effectively control the yield curve. You see, it used to be, back when I got into institutional markets back in the 1980s, there was a group of people known as the bond vigilantes. Well, the bond vigilantes are like dodo birds. They're all dead. They don't exist anymore, and the last of them probably died, I'm going to say, 20 years ago. And they died coincidentally at the same time, I'm going to say, round about the time when Glass-Steagall was repealed in 1998, which allowed the investment banks to become major players in the derivatives, the OTC derivatives markets, and turned our entire capital markets edifice into a casino. And the unshackling of banks, and I mean, it was a multifaceted approach that was used, because what officialdom came to understand through the 1990s is that they could control the entire yield curve, basically rendering the bond vigilantes impotent. And they are impotent because there is no, as people believe, when interest rates are forced to zero, people believe it's a flight to quality. That's the way it's been dubbed by officialdom. They attach these monikers which try to explain away the inexplainable. And having interest rates at zero with the degree of money printing that's going on is something that doesn't compute. Like, the sun doesn't shine when you have thunder and lightning storms. And to say that in the face of record issuance and ridiculous record issuance of debt by U.S. government, to think that rates are at zero is sort of like me telling you that the sun's shining when the sky's black and we have lightning bolts and thunderclaps going on all around us. They're not simpatico. So what it's all about is that when we give numbers, and I'm just going to recite some numbers here. Total derivatives aggregate outstanding held by American financial institutions at the end of Q4 in 2019 was $228 trillion. That sounds like a pretty impressively big number. I want you to understand that over 80% of that aggregate amount involves interest rate contracts. So the derivatives complex is heavily skewed towards interest rate contracts. And with these interest rate contracts, especially when officialdom gets involved, they tend to be on one side of the trade where they, in swap terms, they receive fixed. They synthetically lend, okay? Which is another way of saying they synthetically create demand for U.S. government debt, transaction demand for U.S. government debt, whether it's a 3-year bond, a 5-year bond, or a 10-year bond, or a 6-month, 3-month, or 1-year T-bill. They have the ability to make banks captive buyers of U.S. government debt in any amount they choose to do. So I gave you the number of total outstanding aggregate derivatives at the end of 2019. So now let's move forward to the first quarter of 2020, when the effects of this alleged pandemic were beginning to be felt in our global markets. The yield on the 10-year bond in the first quarter of 2020 fell from 1.80 to 60 basis points. So it was cut to a third of what it was 3 months earlier. Well, guess what happened to the total amount of derivatives aggregate outstanding from 228 trillion at the end of Q4 in 19 to the end of Q1? That amount had swelled to 267 trillion. So we saw a very, very sizable bloat in the outstanding aggregates, and that embodies the increase in transaction demand that was created by officialdom by being receivers of fixed in the swap market and by selling FRAs at the short end of the market at rates under T-bills. If I sell you an FRA for 6-month LIBOR under T-bills, you're going to do that trade all day long because you can lock in instant profit and it's no risk to you. And the reason for that is LIBOR is always going to be higher than T-bills. So, and anyway, this bloat from 228 up to 267 trillion in 3 months created unbelievable trillions of dollars of demand for U.S. government debt.
So let me understand. We got like $40 trillion in one quarter added to this transaction demand.
To the aggregates. In
the aggregates. And then what happened either because of that or simultaneous with that is driving down the 10-year Treasury bond from 1.8 to 0.6.
Because the banks were made risk-free captive buyers of U.S. government debt, meaning they couldn't lose on the trade.
Nice job if you can get it.
Yeah, well, you see, this is why, Dunnigan, let's first off say that, these big numbers I'm giving you, 98% of the action is held by 5 institutions. Okay, and those 5 institutions are JP Morgan, Citibank, Goldman Sachs, Morgan Stanley, and Bank of America. So those 5 institutions run books, derivatives books, anywhere from, say, 40 up to 53 or 4 trillion currently. And that is the lion, and I mean the massive lion's share of all this. And these guys have been running books this size or bigger for 20 years. And not one of them has ever got it wrong. You see, if you get it wrong when you have a $50 trillion book, you go bankrupt very quickly because you eviscerate your regulatory capital. I mean, if you're offside by 1% on a $50 trillion position, your capital's gone as a bank. And how is it that these banks have never got it wrong? Have you ever traded and never had a bad trade?
I wish.
You see, I worked in these markets back in the 80s. And my biggest client was the biggest client in the world at the time in derivatives. Citibank Canada Toronto. That's where these interest rate derivatives were birthed, is here in Canada. Citibank Toronto was the biggest player in the world. They were the clearinghouse for Citibank worldwide, and Citibank was the biggest institution in this trade for over a decade through the 80s and 90s. And when the people in New York figured out how powerful these instruments were, and in fact that they could be used to control the yield curve, that's when the Citibank Canada Toronto derivatives book was repatriated back to New York in the early 90s. Because that power wasn't going to be allowed to rest anywhere other than New York, where the Fed and the U.S. Treasury had a hands-on involvement. The guys who ran the book at Citibank back in the 80s, who I knew very well, became friends of mine, spent a lot of time with them. These guys got it, but let me tell you something. Because I knew them and had intimate contact with them, they had losing days. They had losing months. A losing day or a losing month today could be the end of a financial institution if we had free markets. The reason they never fail is because on the other side of the bulk of their trades is the Exchange Stabilization Fund, a dark adjunct of the U.S. Treasury. When the Exchange Stabilization Fund engages you to be a payer of fixed, they're telling you right up front that they're synthetic lenders, okay? And they're telling you that you can engage in a huge trade where you have no risk, but they're giving you an absolute guarantee that rates are going down. And then, of course, doing what banks do best, they front run that because they have intimate knowledge that the ESF is going to force rates down. That's why they're never on the wrong side of this. That's why they've never slipped up. And that's why banks haven't gone bankrupt wholesale all over the place. The fact that these banks can run books this size for 20 plus years, and not one of them has ever had a major blow up and lost $1 trillion is absolutely stupefying to me. Okay? It would be like, listen, it's in such a realm of improbability that they would all have books this size and go for 20 years times 4 quarters. So you're talking 80 quarters, 5 institutions, and not one of them has ever blown up. That would be like saying Tiger Woods plays 4 rounds of golf in a major championship and doesn't get 1 par. Guess what? That doesn't happen in the real world. Impossible. Equally as impossible, if someone told you that a professional golfer played 4 rounds, I'm using golf because it's the Masters are on right now. It's something I happen to like. And, I mean, we're all locked down. You can't go anywhere. You can't go eat anywhere. You can't go to a movie. So I watch the Masters. Anyway, but I mean, if I said I played 4 rounds of golf and I got nothing but birdies on my scorecard, you would say, Rob Kirby, you're a lying fool. That's impossible. Well, guess what? 5 institutions over 80 quarters in 20 years not having a blow up, when running books the size they are, is not possible in a free market world. Mm-hmm. So we don't have free markets. And it's these derivatives that give the powers that be control over the interest rate environment and the whole interest rate curve. And to sort of drive home the point, I gave you Q4 of 19 right. versus Q1 of 20. And now I ask you, Dunnigan, what is the 10-year yield today?
About 1.6, 1.7.
Yeah, 1.64 last time I looked today. And guess what the number was for total aggregate OTC derivatives at the end of Q4 20, which is the last quarter we actually have reporting on right now. You see, these numbers are reported 3 months in arrears. So we didn't get Q4 numbers for derivatives until the end of March of this year. Okay? So in Q4, when the 10-year bond had backed up to about 175, if my memory serves me correct, the number had, this outstanding aggregate number had shrunk to 218 trillion. So that's like a 50 trillion reduction from the high water mark at the end of Q1 of 2020. Mm-hmm. So less transaction demand, interest rate curve starts to normalize, and yields go up. And that's exactly what's happened. Okay? You can follow these things, but doing so is a little bit tricky because, you see, because you're looking at data that's published 3 months in arrears, right. It's sort of like if you can imagine sitting in a car, looking out the back window and making notes about the change in scenery as you drive forward. This is our predicament. I mean, let's just say the interest rate environment is not reported to us in a very transparent fashion. And the efforts of officialdom to make us believe their narratives, they sort of shake and roll with developments as they occur as we move along. But let's just say this. The amount or the aggregate amount of outstanding derivatives in the OTC market is roughly, or was roughly, at the end of 2020, was 50 trillion less than it was at the end of Q1 in 2020. So that's how they're used. You create transaction demand, and you can affect the value of the underlying thing. And from there, I want to transit to another area where transaction demand has created a material change in a market. And here I'm going to talk or reference the cryptoverse, which is highlighted by Bitcoin, and gold, one of my favorite topics. The price of gold at the end of September, or sorry, at the beginning of September last year, the price of gold was $1,900, roughly an ounce. The price of Bitcoin was roughly $9,000. Today, the price of gold is trading, I think, around $1,750. Bitcoin's at $58,000. What happened? What is a big line item that explains what occurred? Why is it that Bitcoin's gone to 58,000 and the whole cryptoverse has gone up vertically? Gold has languished. Silver has languished. Well, the way it is that I talk about transaction demand. You see, we have two countries in this world that are very, very rich in natural resources, specifically in crude oil. I'm gonna reference Venezuela and Iran. The buyer of their oil, or the country that really takes down their oil, is China. And China is known to be ravenous and have an insatiable thirst or demand or hunger for gold bullion. Everyone knows that in the gold universe. But what they did back in September is Iran and Venezuela, because of sanctions that have been put on them by America, they've been excluded from using dollar settlement or making payments via SWIFT, which is the dollar settlement mechanism we have globally to settle international trade accounts. So what China did is they said, you know what? Because dollars are of no use to you and we still want your oil, we'll pay you in crypto. Okay, so what are the implications of that? It means that instead of having dollars, which they cannot transact, Venezuela and Iran getting paid for their oil in crypto could skirt the sanctions that America placed on them, and they could in turn take the crypto and buy goods they need from China and basically skirt the whole sanctions situation put in their way. So, you see, it's amazing how the sanctions imposed by America ended up being a double-edged sword. It cuts both ways. And there's a saying in our world, it says necessity is the mother of all invention. And when you tell people they can't transact in dollars, they will find another way to transact. Historically, this would have fallen to gold or silver or both. But that's not allowed anymore because, you see, transacting in gold and silver requires dollar settlement because gold and silver trade in dollars. All the markets for gold and silver are dollar-centric. COMEX is dollar-centric. LBMA is dollar-centric. You can't phone up the LBMA and say, I would like to buy 50 tons of gold from you and pay for it in Bitcoin. They won't do it. You can't do it. So what's occurred instead is China is doing business with pariahs in the American context, and they're paying in crypto, and the crypto is then being recycled back to China for goods and services provided by China. And this way, China gets to basically de-dollarize their international trade to some extent, and that works well for the Chinese. So this is what's going on. And you see, the increased transaction demand drove the value of cryptos up dramatically. Just like the increased transaction demand for 10-year bonds created synthetically in the OTC swap market drives yields down, prices up for U.S. government debt. Mm-hmm. So that's the way I see it, and that's reality. And if you don't get it, you need to, because that's what's causing so much of what's going on in our world and in our capital markets today.
A couple questions about this. Want to make sure I understand, at least at a very high level, the impact of the Fed's actions on, or the exchange stabilization fund you mentioned, on the derivative complex versus the 10-year yield. It's been said over and over again in the mainstream financial press, whenever they talk about the Fed changing, wanting to affect the interest rate or yield curve control, there'll be some disclaimer statement. Now, the Fed can't affect interest rates directly. All they can do is this, and then they hope that that'll have that effect. But you're saying, actually, that by making the banks captive buyers of U.S. bonds and doing this action, they can, in fact, force the 10-year Treasury pretty much wherever they want it.
Yeah, that's what I'm saying. Yeah, they do. And they've been doing it for a long time. You see, the interesting part of all this, the Fed makes claims that they're not involved in the markets to the extent they appear to be. And the reality is, it's technically not the Fed. It's the Exchange Stabilization Fund. So they've basically given you, I call it a white lie. And it is a white lie. Because when the Exchange Stabilization Fund operates in markets, they only do so through the trading desk at the New York Federal Reserve. So to a layperson, it looks like it's the Fed doing this, but it's really the Treasury. It's the ESF. They are the one who makes our markets move. When it's decided by officialdom that they need direction. It's the Fed executing the orders of the ESF. So the Fed can stand on their soapbox and say, we're not in the market. No, you're just acting as an agent for the guys that are. But to say that they're not aware, now that's just a complete bold-faced lie, because they know. They know where their bread is buttered. And they are never going to out the ESF. Because if they out the ESF for what the ESF is actually engaged in, there would be revolution overnight. And the institution would be shut down.
Now that's the next question I had, is what's the consequence on Main Street and on individuals? So you were describing this wondrous, miraculous thing that happens for 80 calendar quarters across all these different institutions where they don't have a single significant loss across all of their derivative trades, and it's all wonderfully backstopped by the Fed. Sounds like a marriage made in heaven. Sounds like it's a win-win for those two players. How does it play out for Main Street and for the ordinary individual? Why should we care? Why is it important?
Okay. How does it play out for us little people?
Yeah.
Well, if you happen to be of retirement age, and if you happen to have investable assets, You can't invest and make any kind of a yield to support yourself. So you see, people who've been prudent, people who have saved are being punished. Retirees are being punished. Pension funds are being punished. Interest rates aren't naturally at zero. Interest rates were forced to zero. And if I force you to live in an environment where you get 1/10 of the air you currently get, you're not going to be a healthy Dunnigan very long. You're going to get very sick very quick. Well, what's happening to the retirement population? They're getting very sick very quick. Because that's the way it works. Because they're all yield starved. And do you know what that forces those people to do? Because they can no longer get yield from their fixed income quotient in their investment portfolio. It forces them down the risk curve. And they end up taking bigger and bigger and bigger risk elsewhere to try and make up for the lack of return in fixed income. So we basically have turned everyone into, everyone has a seat at the casino table now. And everyone's gambling. Because if you don't gamble, you don't earn anything. And if you don't earn anything, you're finished. Because you need nominally, you need funds to survive. And they just make it that much harder. It's like when I talk about giving you 1/10 of the air that you formerly had, you know, you don't make out too well. Well, on a macro level, that's what's going on in the investment universe. And it's turned hedge funds into complete gambling addicts. And the banks are complete gambling addicts too. You see, and what they've done is they've devalued, and of course, this has all been accompanied by money printing. And much of these actions have been employed with the express purpose of negating or trying to make people believe that all this money creation, like $8 trillion in the last year alone, that's acknowledged, they want people to believe it's benign and it's not inflationary. Well, guess what? It is inflationary. That's another part of the reason why Bitcoin's at 58,000. That's another part of the reason why housing prices are. That's another part of the reason why, despite half of the economy being shuttered, we're getting record high prices in equity markets like the Dow, the NASDAQ, and the S&P.
We just had a glitch.
Yeah, I know. That's a coincidence. Unless you're a conspiracy theorist. Of course. Yeah. Well, that's the reason all asset categories other than gold and silver have taken off like a scalded cat. Unbelievable. Making heads or tails of it for the average person is very difficult.
Related question from William C. says that if the deep state controls everything now, will they ever let silver loose?
Well, you know, Dunnigan, it is strange, isn't it, that basically every financial asset on the planet has taken off like a scalded cat, except gold and silver. And historically, these are two assets in particular that would be very, very finely tuned to monetary debasement, excess money printing, and they've been rendered basically, they're basically like cats that have had their claws removed, is what they are. And there's an infinite supply of gold and silver futures, but try buying physical ounces, as you know, because you're in that trade, and physical ounces are not readily available. They're just not in size. And, you know, for most people who want to, like, if you want to procure a couple thousand silver maples, or 1,000 silver maples even, or eagles, I mean, most people, you got to pay your money up front. You're probably waiting 4 to 6 weeks to get them. But you'd never know it by looking at the price of silver on COMEX. I mean, what? It's been slammed again today. It gets slammed every other day. And it's just ridiculous. Housing prices keep going up. Bitcoin keeps going up. Cryptos keep going up. Gold and silver can't find a bid, seemingly. except you can't buy any at the coin shop. So anyway, and one day people will wake up and say something about that doesn't add up.
Yeah, that's a question here from John Cruikshank, who says, Rob, with the curtain finally being pulled back on silver, I think he's referring to this populist groundswell of the last wave of the physical silver rush. It started out at the sovereign level, then it was central bank, different levels, and now it's gotten down to the retail level. People trying to grab physical silver, and the exchanges coming up pretty well close to dry. He says, how long does the fiat currency price mechanism have before there's too much of a disconnect between physical and paper, and it becomes obvious?
Okay, so, and I guess my reply to that is, how long will David Copperfield have an audience? Because David Copperfield tells people, and people go for the entertainment value to see him make a Learjet disappear. Do you really think Learjets disappear? I mean, Learjets can crash, and I guess that would kind of sort of be one way to make them disappear, but they don't disappear behind curtains. Not on my planet. Now, maybe on yours, but not on mine. So, how long are people going to put up with the garbage that we're being fed by spokespeople for our mainstream financial press? And I don't know the answer to that. I mean, I've completely divorced myself from anything that I would consider mainstream. I don't believe it. I think everybody needs to own some physical metal, because I think the day this does stop working for the powers that be, you will not be able to buy physical metal. And at that point in time, I do believe that metals prices will reflect the true scarcity of physical. But until that occurs, we're living under despotic regime that makes or has resigned themselves to keeping nominal prices of metal to support their narrative that everything is okay in our financial universe, and it isn't. Okay? The monetary unit is doing what the monetary unit is supposed to do by its very design. I mean, Keynesian money philosophy is hideously flawed. Okay? And it was pointed out to John Maynard Keynes back in the day. He was told by academics, he was told by bright people, your system is critically flawed and ends in failure. And his response was a shrug and we're all dead in the long run anyway. He didn't care. He just didn't care. You see, and the people today don't care either. The philosophy of the people that control our monetary system today is all about living to play another day.
Well, that's what I was going to mention is you say that the Keynesian monetary model is flawed, but you could say that until you reach a point where the exponential growth runaway can't be sustained any longer, it does provide an amazing opportunity for those who understand the power of the exponential growth function to make a huge wealth transfer and to capture, concentrate power.
Now, Dunnigan, to understand that relationship, you need to go to Chris Martinson's website and watch the crash course, because it explains the effects of compounding, and it literally is a dot to dot, connect the dots to get the picture, and it explains and shows how money with compound interest, fiat money with compound interest, ends in disaster. And it explains it very effectively. And kudos to Chris Martinson for having produced it back in 2009.
I mean,
and
I think
it's a wonderful thing to watch.
Yeah, I mean, you could have had Keynes reply instead. If somebody says, hey, this ends in disaster, he could have leaned forward and said, shh, You'll enjoy the ride up to a point. For people who are on the power side of that curve and can take advantage of it and take it away from ordinary people. But you're right. You talked to us earlier about savers, earners, retirees are going to be on the losing side of that.
Yep, and they are.
We have a question here from Fat Vegan. You mentioned China. You mentioned international trade being settled outside the dollar, etc. The Belt and Road Initiative by China is going to encompass 60% of the world's population. When done, what will happen to the U.S. dollar as the world reserve currency?
Well, I mean, the U.S. dollar's role as the world's reserve currency, in my view anyway, is beyond its due date. So, countries are making, you see, I said earlier in this interview, necessity is the mother of all invention. The world is trying to de-dollarize, and the world will continue de-dollarizing. And U.S. dollars are going to be used less and less and less in trade going forward, which presents a huge problem for the U.S. government, whose debts are getting bigger and bigger and bigger. Mm-hmm. There is no appetite for this debt internationally. And the U.S. government, through covert money printing, and this is something that I don't think virtually nobody will even dare mention this. Like, we know that $8 trillion roughly has been created in the last year to support all this response to the pandemic. My serious question is whether the pandemic was a response to a failing financial system, because I believe it's intentional. Mm-hmm. And I honestly believe that the degree and the amount of money creation that has actually occurred is probably far in excess of the 8 trillion that's acknowledged. And my thesis or my observation and commentary on that would not conflict with the work of Dr. Mark Skidmore mm-hmm. and his look at the action that's going on under the umbrella of the Social Security Trust Administration and the management of retirement assets for Americans, where in the last year that Skidmore was able to do work, I believe it was 2019, we have roughly $400 billion in investable assets under the umbrella of Social Security trust funds, and that the turnover in those $400 billion in 1 year is reported by the government to be $44 trillion. Well, if you really believe that investment or retirement assets are managed in that fashion, I say to you, think again, mm-hmm. Because that is not anyone managing retirement assets. If they dared try to do a tenth of that, they'd be fired on the spot. Mm-hmm. Okay, that is not the way retirement assets are managed. So then the question becomes: so what's really going on then? I believe it's just been turned into a wholesale money. It's fraud. I mean, it is a fraud, and I mean the debate is what flavor of fraud is it? But it's fraud, and it's sort of like saying it's ice cream, and it's like, well, what flavor of ice cream is it, Rob? I don't care. It's ice cream, and it melts if you take it into a warm place.
Yeah.
And everything's heating up. And this scam will ultimately be revealed, and that's when heads will roll or people will swing from ropes, or there will be complete revolution.
Yeah, that's what I was going to say. Is the track record is not for law and order or consequence. Truth and consequences has not been the track record for the past several decades. It's been basically impunity above certain levels of elite in many different categories. We have a question here from Martin Zekov. We've talked about the importance of gold and the fact that a lot of efforts are being made to suppress or to prevent the expansion of the value of valuations applied to gold and silver, apart from all other assets that are allowed to bubble.
Somebody doesn't like what we're talking about again.
Oh, we got another glitch there. Sorry. Well, Rob, we had more questions to get to, but the internet connection we've been experiencing lots of glitches on, so we're going to have to probably wrap it up here. We just are very grateful for your presence with our audience here on Liberty and Finance, and just hope we can get you again real soon. Thank you for coming back on.
It's been my pleasure, Duncan.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com.